Good evening, ladies and gentlemen. On behalf of CFA Society Sri Lanka, I would like to welcome you to the webinar on ESG from a perspective of investors and corporates jointly organized with the CA Sri Lanka. ESG has been a topic which has gained investor interest over the last few years. And today, more than 100 trillion assets under management is influenced by fund managers who have signed up to the global best practices on ESG. Today, you will hear from two eminent speakers, as well as have a panel discussion with the speakers and industry participants on this very interesting topic. With that, may I hand over to Mr. Manil Jayasinghe, President of CA Sri Lanka, to say a few words. Over to you, Mr. Jayasinghe.
Thank you, Dinesh. Mr. Dinesh Swaraswithan, President of the CA Society Sri Lanka, Mr. Asitha Talwatha, Chairman of the Corporate Governance Committee, Ms. Mary Lung, Head of Advocacy, APAC of CFA Institute, Miss Ruby Oja, Senior Environmental and Social Development Specialist at IFC, Mr. Rajiva Bandaranaike, Chief Executive Officer of the Colombo Stock Exchange, Mr. Mohan Tantirage, Group Financial Controller of John Keells Holdings. Ladies and gentlemen, good evening to all of you all. I am pleased to join you all virtually as CA Sri Lanka and the CFA Society Sri Lanka joins hands to focus and encourage more companies to embrace ESG in our efforts to help corporates be more socially and environmentally responsible. At the outset, I would like to thank our guest speakers and panelists for accepting our invitation and joining us at this forum, which comes at a crucial juncture amidst turbulent and uncertain times. The last 2 years have been unprecedentedly challenging to all of us. While we have been shrouded by darkness, the COVID-19 pandemic has also created new opportunities for small and big businesses alike. But while the pandemic continues to reverberate at local level, the increasing influence of environmental, social, and governance continues to be important areas under investor scrutiny. I think, as Dinesh very rightly mentioned, while COVID has led to unprecedentedly volatility, it has also changed the investment and capital market landscape, sharpening the focus on ESG and sustainability and increasing awareness of social factors. Therefore, to encourage more companies to embrace this area as a part of their corporate responsibility, CA Sri Lanka, together with its Corporate Governance Committee led by Mr. Asitha Talwatha and CFA Society Sri Lanka, have joined hands to kick start a dialogue on on it amongst our corporates. Even at a local level, we already have companies focusing on ESG, companies such as John Keel's, but we need obviously to do more to embrace this concept if they are serious about long-term sustainability. Challenges are nothing new, but certain challenges take time to overcome, and global warming can be one such challenge. Therefore, corporates, including large organizations, must continue to be environmentally and socially responsible by embracing ESG in their thinking as well as business practices. It is no secret that most companies in businesses are responsible for a certain percentage of emissions, pollutions, and whatever may be due to their business operations. However, while it's not possible to totally eliminate these emissions and pollutions, I believe corporates must at least try to reduce their carbon footprint. As finance professionals, we all have an underlying responsibility to play a crucial role in mobilizing and promoting greener investments and ensure a greener economy. If we are serious about saving the planet for the next generation, we can debate about future challenges stemming from technology to regulations, but first we need to safeguard our planet. So I urge you to expand your way of thinking and act as responsible professionals and citizens. As a professional body, CS Sri Lanka and CFA Society can impart knowledge and give you the necessary lead in driving this change. But eventually, it is also in your hands, individual professionals who are responsible to help make this planet a better, safer, and a cleaner place for everyone. Thank you very much, and I hope this will become a very useful and informative session so that it can move forward and everyone embrace these concepts. Thank you.
Thank you, Mr. Jayasinghe. With that, I would like to invite the first speaker for this afternoon, Ruby Oja. Ruby is a senior environmental and social development specialist with the International Finance Corporation of the World Bank Group. And she's a team leader for South Asia in the ESG department of IFC. Ruby has more than 20 years of work experience and has worked extensively on assessing E&S risks and providing recommendations to IFC's customers in South Asia. Without further ado, over to you, Ruby.
Sure. Thanks a lot, Dinesh, for the introduction, and thanks, Manil and Aruna for inviting me to be a part of the session today. It is indeed a great pleasure for me to be part of the session today and to talk about ESG for sustainability, which is very relevant in the current times. I'm going to present some slides, and the slides will include basics on what is sustainability, what value add it brings, and how IFC as an investor integrates sustainability when working with our clients. So I'll just go to projecting my slides now. If it works. I hope my slides are visible.
Yeah,
yes,
fine.
Ruby, we can see that.
Sure. Okay, so let me first start with what is meant by sustainability in the business context. If we talk about in very simple terms, sustainability would mean meeting our own needs, as in meeting the needs of the current generation, without compromising on the ability of future generations to meet their needs. Now, what it means in terms of the business terms, it implies ensuring that success of the business or promotion of the development, which is very much needed, specifically in this India context. It is ensured while at the same time contributing towards economic and social development. There are four pillars of sustainability, which is human, social, economic, and environmental, meaning that economic benefits are utilized while taking into account the human capital, social, and the environmental aspects. So this is, this is synonymous to what we say as people, planet, and profits working hand in hand. Now, coming to the next question as to how can this be achieved? This could be achieved through good governance, through fair treatment of employees, through addressal of environmental impacts, through addressal of impacts on the local communities. And through addressal of relationship with suppliers and customers. So that's how what sustainability means. It won't be wrong to say that ESG sustainability is aligned with strong financial performance. ESG stands for environment, social, and governance, and is a key component of sustainability. It has been very well established, and there have been premier institutes, including Harvard, who've also endorsed the fact that E&S sustainability is indeed aligned with strong financial performance. And in the next slide, I'm showing us a graph in which Harvard School did a study in 2001. And what they did was they compared two groups of companies. The companies were almost of the same identical size and also operating in the same sector. So we were looking at the same set of companies and compare their financial performance over different years. As you can see in the graph here, company with strong ESG performance fared higher in terms of the financial performance as compared to the one which had weak ESG performance. Now, so I've spoken about how sustainability brings about financial gains. Apart from the financial performance, sustainability also adds value to the investments. And I'll talk about some of the value adds that sustainability brings. First, it guards against unforeseen risk and impacts. ESG performance assessment help the companies identify the risks. It's only when a risk is identified can it be addressed. And it guards against interruptions in the project executions and legal claims, thereby protecting against those risks which could not be foreseen earlier. It improves the financial and operational performance. I spoke about the financial performance in my earlier slide. Implementation of ESG standards can help improve the operational efficiency of a company. It's like a low-hanging fruit and would help a company reduce its water consumption, energy consumption, material footprints, which would translate indirectly into cost savings. Third and the very important aspect is social license to operate. ESG standards help clients find ways to maximize the local development, which results in greater acceptance of the project by the communities and governments, thereby allowing the companies to acquire what we call as a social license to operate, and which is very helpful in the longer run of the operation of the company. It also protects the investments against negative media attention, which could be a reputational risk issues to the investors and stakeholders. All of us are aware of negative media articles related to ESG and how it has impacted the company. ESG assessments, when done against international standards, provide an international stamp of approval and help facilitate access to capital. The less risky a company is perceived to be, the lower its cost of capital. It's just like how we say in terms of an individual, the stronger is your credit score, the better financing you tend to receive. Now going on to the next slide, let's try to understand why is sustainability rewarding. At the center of this slide, this is showing company, which is the, is the company, and then around it are the various stakeholders, such as the community, employees, NGOs, media, financiers. So these are all the various stakeholders. Now, in the let's assume a scenario wherein the company had taken on board all the stakeholders. It would have resulted in a rewarding scenario, as in an operating license, retention of the employees, cooperation from NGOs, reputational benefits, loss of cover if you're talking about insurance, and attraction of long-term investors. In the absence of all this, it would just be the opposite, with opposition to the project resulting in loss of operating license, strikes by the employees, reputational risk in terms of negative publicity and disinvestment. So, as you see that how important it is for a company to take all the stakeholders on board so as to gather a positive momentum. Now, taking an example of a business case here and showing the key benefits, which could be listed under the following heads: risk reduction, cost savings, improved access to capital markets, revenue gains and market access, and brand value and reputation. I've spoken about some of them in the previous slides, but this is just to show that these are the key benefits when sustainability is incorporated in the business operations of any company. I will now move on to how IFC, the organization where I work with, integrates sustainability in its investments. Sustainability is a key component for us, and we help our clients better manage the E&S risk they face. We partner with the clients and handhold them in finding innovative solutions for ensuring a sustainable development. What IFC has is that we have our own sustainability framework, which includes sustainability policy and some other policies as well, and I'll come to that later. But just to mention here that IFC's policies on environment, social, and governance are widely adopted, and they kind of level the playing field for companies so that every company is being evaluated on a similar standard. I'll talk a bit more about the IFC sustainability framework. It includes sustainability policy and access to information policy, which is in the interest of ensuring transparency. We have 8 performance standards on environmental and social sustainability, with each performance standard covering out one thematic area. There are detailed guidance notes developed for each of these performance standards, and also EHS guidelines for various sectors to provide guidance, to provide detailed kind of guidance. IFC's sustainability policy defines commitment of IFC towards sustainability and incorporates various cross-cutting issues as well, such as human rights, gender, climate, corporate governance, amongst others. The sustainability framework also defines the mitigation hierarchy and mentions that as a first step, the attempt should be to avoid risks and impacts. And if that's not possible, the next step should be to minimize the impacts through incorporation of mitigation measures. When both of this is not possible, the last resort is compensate or offset. So this is the hierarchy that we expect our clients to follow for all investments. Now, I'll just go a little more detail about each of the performance standards. As I mentioned earlier, there are 8 performance standards, and each one of those covers a thematic area. PS1, which is the assessment and management of environmental and social risks and impacts, is the umbrella standard covering assessment and management of risks and impacts. So as I mentioned earlier as well, risk identification is the first step to identify ways of managing risk. The PS, and I'm going to use the word PS, which stands for performance standards. PS1 aims to assess the existing social and environmental management system of a company, and which include different components such as EHS policy, the institutional structure in place with defined roles and responsibilities on E&S, risk identification and management procedures, together with processes related to stakeholder engagement and grievance management. PS2 is on labor and working conditions. This PS is actually guided by a number of international conventions on labor and workers' rights. And some of the key themes which this PS2 covers relate to human resources policy and management, workers' organization, retrenchment, protection of the workforce, occupational health and safety. And it applies to workers who are engaged directly by the employer, which we call as direct workers, or the workers engaged through third parties, which we call as contract workers, and also the workers engaged by the client's primary suppliers, which is called as a supply chain workers. So the requirement of this performance standard would apply to all category of workers, which I just spoke about. PS3 relates to resource efficiency and pollution prevention. The objective of this PS is to avoid the adverse impacts of pollution on human health and the environment. The different themes which are covered as part of the PS3 include pollution prevention, resource efficiency, waste management, hazardous material handling, emergency preparedness, greenhouse gas emissions, pesticide use, all the terms related to pollution that you would have heard of. PS4 relates to community health, safety, and security, and it requires the due diligence to avoid adverse impacts on the health and safety of the affected communities, which are living in vicinity to any of the projects, both from routine and as well as from non-routine circumstances. It requires that the security personnel is enough safeguarded. So the key thematic areas in this include infrastructure safety, hazardous material safety, exposure to disease, and emergency preparedness and response related to the communities. PS5 is something which we find quite, the issue which we find quite relevant in South Asia specifically, land acquisition and involuntary settlement. So PS5 requires the project to anticipate and avoid adverse socioeconomic impacts from land acquisition. The key thematic areas which are covered as part of this PS include compensation and benefit for the displaced persons, incorporation of a mechanism which involves consultation with the affected communities, and implementation of an effective grievance mechanism, together with planning for the resettlement and implementation. That is what is needed because of the development of a project. PS6 pertains to biodiversity conservation and sustainable management of living resources. This PS actually applies to projects which would be developing in an area which what we call and which is defined in the IFC performance standard as a modified natural or critical habitats, or the projects that have the potential to impact the ecosystem services where there is dependency of community. So PS6 actually screens the relevant threats to biodiversity with specific focus on habitat loss, degradation, and habitat fragmentation. So these are the key areas that are covered. PS7 is related to indigenous people, or what we call as the people who are native to a particular region. It applies to communities or group of people who maintain what we call as a collective attachment, which means that whose identity as a group or a community is linked to distinct habitats and the natural resources that are available therein. The key themes which PS7 covers is consultation and informed participation, which of course is a common aspect which is covered in PS1 or PS5 as well. Evaluating impacts on traditional or customary lands and the cultural resources. And the last PS is the PS8, which is on cultural heritage. This PS applies to any features which have cultural importance to the local population, and it requires that identification of the cultural heritage is made as part of the E&S diligence and mitigations incorporated. As I talked about the important thematic areas, this touching base again on out of these 8 performance standards, the key thematic areas that have been covered are something that are very relevant in today's aspects: climate change, biodiversity, resource efficiency, human rights, stakeholder engagement, gender, supply chain. So these are the different issues which are covered in quite a detail in both the IFC performance standards as well as in the guidance. Now, just to talk about the performance standards and what is the global benchmark. The performance standards are recognized as a global benchmark for environmental and social risk management. They are actually the basis of the Equator Bank principles and are applied by several developmental finance institutions, what we call as DFIs. Some of the governments are also using IFC standards in their policy guidance as a reference point. And the Equator Principal Finance institutions cover more than 70% of the international project finance debt in the emerging markets. And not just this, PSS are also recognized as benchmarks for other financial institutions, industries, NGOs, and many commercial banks. As you can see in the figure here, various banks or organizations which have adopted the performance standards has been included. So with this, that's all I had to present today. Happy to look forward to any questions that may arise later as part of the panel discussions. So thank you once again. Thanks.
Thank you, Ruby, for the insightful presentation. I would like to invite our next speaker for this afternoon, Mary Leung, who's the Head of Advisory Asia Pacific for the CFA Institute. She leads the team that is responsible for developing and building market integrity in Asia Pacific for the CFA Institute. She has over 20 years experience in the global financial industry, having worked in many senior roles across the globe. Without further ado, may I hand over to Mary for her presentation. Over to you, Mary.
Thank you, Dinesh. And I would like to start by sharing my screen. I have some slides that I would like to share with everyone. Okay, so first of all, I would like to thank CFA Society Sri Lanka and the Institute of Chartered Accountants of Sri Lanka for inviting me to today's webinar and giving me this opportunity to talk about a subject that I'm actually quite passionate about, and that's ESG and sustainable investing. So today I'm going to have a few slides on the trends in ESG and sustainable investing globally and in the region, in the Asia-Pacific region, and how these trends are driving some of the changes in the investment management industry. Throughout this presentation, I'm going to use the term ESG and sustainable investing interchangeably. ESG obviously stands for environmental, social, and governance factors. And I think we've heard from Ruby about some of these factors that will drive value. So let's start with trends. So without a doubt, we are seeing globally and in the Asia-Pacific region, massive structural shift into ESG and sustainable investing. And these are driven by three key factors. First, we're seeing increased awareness by investors of the potential impact of ESG factors on the value of their investments. And this impact can be both positive and negative. So for those companies that can harness ESG-related opportunities, it's positive. For those that fail to manage ESG risks, that's negative. So that's the first driver. The second key driver is the greater availability of ESG disclosures by issuers, as well as ESG data and information from third-party providers that help in investment decision-making. So, for example, many stock exchanges in the region are mandating or requiring companies, listed companies, to provide non-financial ESG disclosures. And we've seen quite a bit of improvement in that area in the last 5 years. Now, ESG information is still by no means perfect, but there's some way to go. But we have come a long way. And I know that many of you in the audience are in the accounting profession, and you will also have a role to play in making sure that there's timely, consistent, and relevant information that issuers are providing that will allow capital allocators and investors to have the relevant, to have decision useful information to make decisions. And the last point that I want to make is the intensifying regulatory scrutiny on greenwashing. Greenwashing means that some products, investment products, can make claims about being green or meeting ESG criteria or being sustainable more so than they really are. So that's the term that we're using in the industry, greenwashing. So there are many regulatory efforts globally and in the region to make sure that investment managers can't get away with greenwashing. And this ultimately will help raise the level of transparency and trust in the industry. So if we look at the next slide, it's a table of sustainable assets under management by region. And the data comes from Morningstar. So obviously Morningstar has their own definition of what makes a fund sustainable. But if you look at this table, it was as of March 2021. If you look at this table, there is no doubt that Europe is the single largest region when it comes to sustainable AUM. And not only not only just in the amount of AUM, but also in the number of funds. So 82% of global sustainable AUM is actually in Europe. It's perhaps unsurprising because the region has actually taken sustainability as their top-down policy, and they wanted very much to move their economy to a circular economy, and everything kind of flows from that. So they are working very hard to reorient private capital to sustainable investments. And as I said, it's a top-down policy there, and so when the government, when collectively wants to move in that direction, I think everyone's following. Now, Asia Pacific is shown here in 3 rows. We have Asia, excluding Japan, Australia and New Zealand, and Japan. And if you roll those 3 rows all up, it adds up to about 5% of AUM and 11% of funds. Now, what does that mean? If you think about Asia Pacific as a region, we actually contribute about 60% of the world's population and 40% of the world's GDP. So if you look at these numbers, it seems like Asia Pacific is punching well below its weight when it comes to sustainable AUM. And so the next question you may want to ask is, well, do ESG issues apply in Asia Pacific? And I'll tell you the answer is absolutely. ESG issues absolutely apply in Asia Pacific. Let's take governance as an example. Listed companies in this part of the world tend to be controlled by a small number of shareholders. So they can be founders, families, or states and governments. So there's a relatively low level of institutional ownership. So getting governance right is extremely important from the perspective of investor protection. So that's one example. Another example is, of course, environmental issues, which have been getting a lot of headlines lately. So if we think about the landscape, right, that's Asia Pacific, population and assets and urban areas in Asia Pacific are highly coastal, and they're at risk of climate change-induced extreme weather events. Now, that being said, we are seeing strong pickup in activity in terms of sustainable assets under management in Asia ex-Japan. So in the last 6 months, there have been strong inflows. According to Morningstar, they have seen about $15 billion and over 30 new fund launches. And China, Taiwan, and South Korea are the most active markets. But clearly, there is still quite a bit of room to grow. And that's the business opportunity that both the accounting profession and the investment management profession cannot ignore. This slide shows the number of the amount of assets under management for sustainable ETFs. For a long time, ESG investing has been confined to active strategies, but no longer. So in this chart, you can see that the amount of AUM for ESG ETFs has exploded from about $25 billion at the end of 2018 to $227 billion at the end of February this year. So in the space of less than 4 years, we're looking at a 10-fold increase, 10 times. So what we're seeing is two mega trends at play. So first is the shift into sustainable investing, and the second is the ongoing popularity of passive investing. And they normally take the form of ETFs. Now, obviously, there's some ETFs in this in these numbers that are active, but they remain a minority. So if you look at the top 20, maybe there's one that's active and 19, the rest are passive. And importantly, ETFs trade on exchanges, right? And they typically have much lower fees than active funds. They also bring additional advantages on liquidity, on flexibility in terms of trading quantities, and ease of entry and exit. So therefore, it's unsurprising that investors have pivoted to ETFs, especially when they're looking at sustainability and ESG as a theme. How has the past 18 months affected the shift to ESG and sustainable investing? Well, if anything, it has actually reinforced it. And what people like to say is that ESG has actually had a pretty good crisis. So if we look back 18 months ago when the world suddenly overnight went into lockdown and the market froze, what happened in the ensuing months was that ESG strategies demonstrated a lot of resilience. So indices of ESG companies have outperformed normal indices, and we actually saw big inflows into these products in 2020 and also in the first quarter of 2021. And many people are actually convinced that companies that demonstrate attentiveness to stakeholder relations, to governance issues, are better prepared to deal with the pandemic and its implications. And that's, I think, the point that Ruby was also making in her presentation. Now, the CFA Institute has done surveys from time to time to gauge investors and practitioners' attitudes to ESG. And here's one that we did late last year. So we asked what is the motivation behind integrating ESG factors into an investor's investment process. And globally, the top two most selected answers were risk management and client demand. So they are the columns on the left-hand side of the slide. We also show on the slide the change between the last time we did the result that we got last year and the last time we did the survey. So as you can see, the second most selected answer, which is clients or investors demanded. So client demand has grown from 45% in 2017 to 59% in 2020. Now, let's go back to the first, the top most selected answer, which is to help manage investment risks. So the World Economic Forum each year publishes a global risk report. And they show the top 5 risks in terms of the biggest potential impact. And on this slide, we have captured the survey results going back to like 2009. And you can see on this slide that the blue boxes denote economic risks, green are environmental risks, and red social risks. So can you see how the risks have moved from a focus on economic risks about 10 to 12 years ago to environmental and social risks in recent years? And that's understandable, right? So back in 2009, 2010, we were coming out of the global financial crisis, and people were concerned about asset price collapses or financial system failures. But in the last 5 years, what has made people kind of lose sleep at night are things like extreme weather events, water risks, food security, natural disasters. And it's, again, unsurprising, infectious disease is right at the top of the list this year. And I think what's interesting to note is that the virus, the pandemic, actually highlights how interconnected our lives and economic systems are. And climate change actually turns up the probabilities of pandemics. And the economic consequences of the crisis increases the need to address inequality and other social issues. Now, let's look at the business opportunity. Recall a couple of slides ago, we were showing that many institutional investors are now integrating ESG factors into their investment process because their clients demand it. In the same survey that we did last year, so we did ask investors if they were interested in ESG strategies, and that's the result on the left. So a majority of retail investors indicated to us that they were interested in ESG investing, and that is kind of growing as well. So, and if you look at the left-hand side panel, the interest is quite high, especially among those in the 25 to 54 age group. So younger investors seem to have more interest in ESG strategies than older ones. Now, on the right-hand panel, we showed the retail investors that were employing ESG strategies, i.e. those who have already put money in these ESG strategies. Now, the two charts, the left-hand side chart and the right-hand side chart, are actually on the same scale. But you can see that there's a big gap, right? Even though many investors told us they were interested, there weren't that many who have deployed funds into these strategies. So you can see the white space between the two charts. And that is the business opportunity that I was referring to. This is the opportunity that investment managers cannot ignore, because there is a lot of pent-up demand. There's a lot of interest from investors, and they're just waiting for the right moment to jump in. So their money has not been spent yet. And as a profession, we need to help them deploy these funds in the way that fits in with their values and can drive some of the changes that are needed for us to transition to a lower carbon world. Now, on this slide, we are looking at why some investors don't take any ESG issues into account. So barriers to ESG integration. And the top two most selected reasons for not doing ESG was the lack of know-how and the lack of demand. And so the lack of know-how, insufficient knowledge of how to consider these issues is something that the team at the CFA Institute has been working very hard on. So as you can imagine, CFA Institute takes talent development very seriously. We have done a lot of work in capacity building in Asia Pacific, in motivating the industry to take action. And on the next slide, these are some of the ESG-related publications that we have published over the last 2-3 years. Some were done by my team and some were done globally. And I hope that some of these publications will be useful to you in your journey to be more sustainable and to embrace sustainable investing. I also would like to close by introducing our website, a portal called Asia Pacific Research Exchange, or ARX, on ARX, not only can you find some of these research, we have a dedicated ESG page with research that's contributed by researchers, academics, brokerage houses, and other institutional partners on ESG. And not only that, over the last year or so, we've done about 30 webinars on the topic, from integration of ESG into fixed income, to impact investing, to social and responsible investing. And these webinars are all recorded and uploaded onto ARX, and they can be accessed for no charge, and you don't even have to create an account. So it's available to everyone. So I hope CFA Institute can be your partner in your ESG journey. And that's all I have today. Thank you.
Thank you, Mary, for sharing the global and regional trends in ESG with our audience this afternoon. Our next session is the panel discussion, which is moderated by Mr. Asita Talvatta, Chairman of the Corporate Governance Committee of CA Sri Lanka. Mr. Talvatta is a past president of CA Sri Lanka, as well as the CIMA Sri Lanka division. He currently serves as the chairman of Management Systems Limited, and previously served as the country managing partner of Ernst & Young in Sri Lanka for over 10 years. And he also serves as a non-executive director of several listed companies in the Colombo Stock Exchange. Our next panelist is Mr. Mohan Tantirige, Group Financial Controller, John Keells Holdings.
Dinesh, you're on mute.
And Mary from the CFA Institute. Let me hand over to Mr. Asita Talvatta to begin the panel discussion. Over to you, Mr. Talvatta.
Thank you, Dinesh. Good evening to everyone. Two very interesting and informative presentations. We're looking forward to discussing some of the matters that were presented and some of the relevant matters that are of interest to all of us. So to Mary, if I may pose the first question, we had, you presented in one of your slides the level of interest among the age groups of 25 to 54 years and the level of investment, the big gap between the level of interest and the level of investment at this point in time. So this is seen as a great opportunity. If one looks a little deeper into perhaps maybe impressions more than research fact, but what would you think are some of the reasons that there hasn't been sufficient conversion? Is it lack of investment opportunities? Is it still uncertainty, though there is interest? Is there a concern that that trade-off between a green investment versus a return? That's one of the things I'd like to talk about a bit today. While all of us have interest and have the altruistic view on greener investments, there's still that desire to make a better return. And at which point does the curve sort of intersect and interact? Would you like to comment, Mary?
Sure, I can have a go. So I think again, Mr. Tawati, I think you've made some very good points. I think there are a number of factors that contribute to the gap. One of it is that there is no standardized definition as to what ESG or sustainability means, or even what ESG investing is. Okay, at CFA Institute, we believe that in order for a proper evaluation of an investment opportunity, you need to be incorporating all the material, financial, and ESG factors. And if that's the definition of ESG investing, then we do not believe that there will be you have to sacrifice return to do that. If anything, you should be getting better risk-adjusted returns. Now, however, there are a whole host of products and strategies that cater to different objectives, and ultimately it depends on what the investors want. So some investors like to see impact, and this impact may be a social impact, and therefore the returns may not be so. For these investors, they're not purely looking at financial returns. There may be a philanthropic angle to it. So that can be one reason why the returns are not comparable, because your objectives are different. And don't forget, I think when social responsible investment first became a thing, probably back 30 years ago, a lot of the strategies involve exclusion. So, so people were excluding certain sectors from their investment universe. This can be tobacco, this can be weapons, or alcohol, or gaming, right? And excluding sectors could also reduce the return, because it reduces your investable universe. So when we talk about sustainable investing, a lot of people kind of have vague ideas of what they want to achieve and what they want to do, and because there's so much jargon and misinformation out there, it also holds them back in terms of, hey, I want to invest in this vehicle, and I want to make sure that it does some good, but I know that I need to do a little bit more work in order to understand the thing, this vehicle or this fund that I want to invest in is the right thing for me, but I just don't have the time. So I think that that has deterred many people. So I think that's one reason. And in actual fact, this is something that, again, the CFA Institute feels quite strongly about. And we are actually working on a standard called the ESG disclosure standard for investment products, which will hopefully raise transparency for investors to allow, to give investment managers a framework to articulate how they achieve their ESG objectives in their products. And through making these disclosures consistent and raising the level of transparency, we hope that investors can better identify and select investment products, which will go towards helping the problem of greenwashing and induce more trust in the industry, which I think is what's needed to make sure that sustainability becomes mainstream in the financial industry.
Thank you. Very useful thoughts on that particularly provocative, if I could call it that, proposition. Mohan, from the perspective of a corporate which has fairly strongly imbibed in ESG aspects, on the same question of the interest versus the gap in investing, how would you position? How does your group of companies position ESG as an important competitive aspect to draw in investors, present it as in your communications and so on? Would you like to comment?
Yeah, sure. Sure. I mean, we are in the business, I think, over 150 years with this reputation of strength, stability, and reliance. I think the straight answer is we want to be in the market more than that, much more than that. I think that's a key thing why we need this ESG matters as a material matters to consider, and the risk factors stemming from these things. I mean, if you start from the whole journey, I mean, if you look at the investors, particularly John Keel's, mostly foreign shareholders, mostly institutional shareholders, and mostly the fund managers. Then when it comes to this, then when it comes to this profiling thing, this is inevitable that any corporate which have this kind of a profiling with the shareholder, you have to move it to this ESG matter and more. I mean, when it comes to the disclosure in particular, I mean that's a key thing. Then if you internalize it, I mean, see that where that drivers coming from the internal. If you want to look at the strategic direction, I mean, for the moment that if you look at what is the next investment going to be, I mean, how we're going to invest and so on and so forth, then it's inevitable you need to put ESG risk matters into your basket. Otherwise, you won't be able to see what's going to happen in the future. I mean, how we're going to do about it, these strategic directions. I mean, over the years that the business model that we develop at John Keells, I mean, we are using, of course, different labels, sustainability, ESG matter, there are so on and so forth. I mean, end of the day, it's the same matter we are discussing here. I mean, the material matter in terms of coming out from this ESG matter, then the informations or other, the inputs feed into this business model, which is taken care of by the ESG matter. I think those are the few drivers, I would say, coming from John Keells and where we are heading. At the same time, if you look at the customers, I think they are getting sophisticated day by day. I mean, they are not just want to, I'm sorry, they are not just want to consume your product or service. They want to look at whole value chain. I mean, where this product emerge. I mean, what form and shape. I mean, whether there's any labor loss is broken like that. Then it is imperative for you to move it to this ESG matter and move ahead with this proper disclosure and so on and so forth. Otherwise, as I keep on saying that we want to stay in the business more than 150 years, then you can't do it without having this consideration as a part of your business journey.
Thanks, Mohan. Moving to Ruby, I mean, if you may just debate the same question a little bit. Now, in your case, you bring in largely debt funding into corporates, and you strongly believe in the ESG factors, which you described well in your presentation. You know, first question is, how far is the gap when you look at corporates in South Asia, for instance? We saw the presentation in Mary's presentation, the level of emphasis in Europe is the highest, and Asia, excluding Japan, is a lot less comparatively, despite the large extent of GDP and the population. So when you must be seeing a fairly significant gap, and how do you grapple with this thing of convincing them of the need? Because they may be at a certain level in the pyramid where they don't see the importance of this, and maybe cultural aspects. And would you like to talk a bit about these aspects, Ruby?
Sure. So as you rightly said, that I totally agree to this, and the range of sustainability issues or the ESG issues that we face in the developing market, or if I may say specifically in South Asia, are quite different from what we see in the developed world. Some of the most relevant issues that we see in South Asia pertain to pollution, population growth related issues with limited access to resources, scarcity of water, biodiversity loss. In terms of the legislative framework or the national legislation, as compared to the developed world, it's very less stringent. There is a non-requirement of identification of E&S risk and impacts. So in the developing world, this is something that is lacking. An impact can only be identified and addressed once it is, it can only be addressed once it's identified. But this is something that is often missed in the developing world. In terms of the second large issue is in terms of the poor labor and working conditions. Occupational health and safety aspects are often overlooked, and we see several of those issues in the developing market, with resulting in fatality of workers or in poor living and working conditions related to their payment of wages, the working hours, the mechanisms in place to address their grievances, and labor accommodation, which is the most neglected aspect in the developed world. Also on aspects like pollution, like related to handling of air, water emissions, and also on waste handling, plastic waste, which is a great hazardous waste, e-waste, in improper disposal of effluents in the waste streams. And all this is because of, one, the lack of resources, and secondly, because of the lack of awareness on these issues. There could be a development in an area surrounded by community, but with no integration of the community aspects. With the South Asia having a high population density and dependence of the land for livelihood, does result in development of projects not paying attention to addressal of issues which relate to physical and economic displacement. And last but not the least, the biodiversity issues not being given enough emphasis One is because of the weak national legislation, and the second is the project design not incorporating the ecosystem services, resulting in fragmentation of habitats and disturbance of the biodiversity aspects. So these are some of the issues that I think are quite relevant.
Thank you, Ruby. I think as the IFC, because of the ability to, bring in capital to large corporates or which have an expansion plan. So you have that level of muscle to, encourage, if I could use that word, encourage compliance with ESG aspects and work with these corporates in taking them to that level. So it may be taking a couple of years before they are ready to be credit-worthy from a ESG perspective. So that's one side from the debt capital. From a stock market perspective, Rajiva, in a similar way, is there some way that you all have some plans or thoughts of encouraging PLCs to venture into better ESG disclosures, maybe better compliance, recognition of the importance of ESG and so on?
Well, yeah, let me break it up into kind of two parts. One is whether corporates have understood the importance and need for ESG. The answer to that probably by and large, yes. And we have seen corporates, more and more corporates adopting ESG reporting, and more importantly, I think internalizing it within the organizations, as Mohan did mention. But I think the larger issue is that the ecosystem may not fully appreciate some of the ESG factors that Mary just mentioned, and particularly in this part of the world, in South Asia, and if you're really talking about retail investors or the local investors may have less appreciation for to distinguish between companies that are in fact green and doing it right from a social and environmental perspective, as against some other maybe institutional investors globally. Well, the other part of it is whether it's adequately covered and whether we are, what measures we are taking. Well, like in some of the other exchanges, we had not mandated ESG reporting as part of our rules, but we have taken two approaches on one part, encouraging ESG reporting voluntarily, as well as mandating some parts of it. For example, on the environmental and social factors, we have been encouraging them on a volunteer basis through multiple initiatives, encouraging sustainability reporting, integrated reporting, etc. But on the governance side, we have made mandatory rules as a country listing requirements for listed companies, and also as enforcement rules, which are embodied in the listing rules. For example, like board composition with non-executive directors, requirements for independent directors, requirement for audit committees and its composition, remuneration committees, related party transaction review committee, etc. So we have built in these governance to those companies. And of course, we have also certain other initiatives that we do encourage. For example, board diversity and to promote gender equality. We partnered with ISC, the Sri Lanka Institute of Directors, and UL Global Compact to draw attention to greater women representation on boards of listed companies. And we have had various ceremonies and initiatives to draw attention to this. We even have a part of a booklet that was issued, which is a compilation of a database of women directors on boards, etc. So we have done it more as a way of voluntarily encouraging and promoting ESG reporting in our jurisdiction right now.
Thanks, Raju. So that shows the direction in which you're also supportive of ESG. Question to Dinesh. I think the CFA Society in Sri Lanka recently, maybe for the first time, launched an award on ESG, and you had a process of selection and so on. What did you all see? I mean, if I may ask the question, in terms of expectations versus what you saw in the disclosures and what you feel can be done better. Do you like to give us some learnings on that, Dinesh?
Yes, Mr. Aldara. So I think you are referring to the Capital Market Awards ceremony,
Yes, that's right.
which was themed on ESG investing. So there we explored the importance of ESG, and more importantly, whilst the investors are looking for ESG compliance, ESG reporting on one hand, there's also a gap in the market for ESG qualified people. So CFA Institute this year launched a ESG qualification, a ESG certification, which we hope will be become the global ESG certification in going forward, like CFA has become the global designation for financial professionals. And this builds on the research we have done over a number of years on ESG and listening to investors what they want. And we are preparing the ESG professionals to deliver that going forward. And like Mary mentioned, we have also working on providing a disclosure standard. So the exposure draft is already out, and I believe the public comment period has just finished. So we'll be looking to incorporate those comments and issue a disclosure standard. So this again has been built based on the feedback we have got from investors. So we are bridging that information asymmetry between what the investors are looking for and what the companies are able to provide. So I think once this disclosure standard is finalized, that would become a global best practice in ESG reporting. And we will also be equipping the professionals with our ESG certification to make those disclosures and investor communications.
Thank you, Dinesh. Maybe at this point, on behalf of CA, I should make a few remarks on the Code of Best Practice of Corporate Governance issued in 2017 has a section brought in for the first time in Sri Lanka, and I'm not sure how much of that is there in the other codes in the region. Where we have requested or voluntary to comply with reporting on ESG matters in the annual report in relation to the disclosures. And the areas we've sort of emphasized are in the context of recognition of the ESG risks, how you measure your ESG risks, how you manage your ESG risks, and then of course the question of reporting. And we've also explained there that most of these ESG risks eventually translate into financial implications. As we were talking, if you take up some practical examples, the kind of fines they've had to pay or losses that have arisen as a result of having to redo work to bring back some kind of implications on, say, an oil spill or whatever effect. So these the justification that we've tried to bring through in the code and to encourage reporting, and we've given a little bit of more detailed guidance on what we mean by environmental. I think perhaps I can refer to Mohan in some of those where we've gone to, even the cost structures in a company, the access to markets. I think Mohan mentioned it, your buyers might also be looking at companies which are compliant, and therefore your top line increase and ability is, there's one, it's a factor which is a business factor, not only a altruistic good governance factor alone. And by efficiency in use of fossil fuels and so on, you might be able to improve your cost structures. So like that, and from the society aspect, we have discussed areas such as the employee part, which was also discussed by many in today's presentation, about retention, training, getting better productivity as a result, and so on. So Mohan, do you want to add a little more to some of those comments?
Yeah, sure. I think we already have the proof of the pudding. We managed to, or rather John Hughes managed to secure $175 long-term loan facility from IFC last June. I think that shows us the way that we have done it. I think surely these things help us to maneuver through the flexibility or the agility that the investment pipeline that we are having, which is a remarkably good thing that happened. I think those are the benefits that I can easily elaborate, which is already proven. The other point is I have done a kind of a clinical study whether the ESG adoption versus whether it supersedes the monetary benefit. But the point here, or other thing that I want to mention is you can't quantify these ESG matters. I mean, you can't put a kind of a value to say that, okay, look here, these are value you're going to derive and so on and so forth. But at the same time, if you look at the other side of the story, that means cost of a reputational damage, cost of a brand image damage. I think cost of all these things that you technically lose your license to operate in the business or license to operate in this whole community, those are devastating. I mean, you won't be able to actually quantify. I think those are the things I have to be mindful in terms of people engage with this as a benefit, engage with this ESG and the sustainability, the standard and so on and so forth. As I said, now there's a movement in the market. They are trying to look at more transparent in the whole trade. Now with this blockchain development, the moment that you link up this blockchain to your value chain or the supply chain, that single QR is enough for you to look at whole heap of information. What's the product that made? I mean, what are the material that you used? And what are the working conditions of these individuals and this thing, whether, I mean, if it is an IP product, what is the consent of this owner of this IP? I mean, that whole heap of information is available with the single QR. If you get into that level of actually detail, and I'm talking about this developed market and more awareness in terms of the customers, then the ultimate benefit that any corporate can achieve is they can be a best corporate citizen. I think that's an add-on that I can make it, because end of the day you can claim that, okay, look here, I'm adhere to this thing, this and that, everything, and we are abide by this thing. Then we are as a part of this society, we are playing the role of being a best corporate citizen. That's my addition to that answer.
Yeah. Thank you. And before we continue, I just want to ask Aruna, do you want to, Aruna, give a little guidance to the other participants or those who have signed in, how they could raise any questions to the panel? Would you want to take a few minutes to do that?
Well, Ms. Talat, if the questions can be obtained from on the Facebook, they can place it. In fact, I forwarded one question for you, so you may
by WhatsApp?
WhatsApp, yeah, WhatsApp, yes. You may
all right,
take that question. So whatever the questions come, we will forward it to you, and you may distribute.
Yeah, I will come to that. One of the other aspects which we thought was interesting to bring out is, now there's three aspects to this: environment, society, and governance. And in environment, for some of those who are less familiar, perhaps please the panelists come in. There is the question, I think in the presentations also we did cover a good part of it, the use of the impact of heavy use of fossil fuels, the effluent discharge, the biodiversity aspects, the displacement of people, and so on, as Ruby clearly explained, the number of 8 areas which she referred to as PS factors. Now, in terms of, so that's one line of, I think, sorry, some of it was in the society space where the customers, the employees, the supply chain participants, if you're outsourcing and so on. And then finally, there's the governance part. So there is a debatable point, which if you get your governance piece right, wouldn't the rest of it follow? Rajiva explained about the mandated part of governance that they have, and that's fairly robust in the Sri Lankan context. Mary and then Ruby, would you all like to comment about, although we keep saying ESG, is it a subset of the overall process of governance? And if you get that right, would these necessarily follow, or it's not as easier said than done, as it were? Ruby, perhaps to you first.
Sure. So I would say that, of course, ESG are integrated in some way, but they're also different in some way. Of course, governance plays a key role, as in it's only if you have the right people in the management, if you have the management commitment to look at E&S issues, only then can you address the issues. So that is, of course, a topmost priority. If you have a management who does not value sustainability or does not wants to incorporate the concerns from the community or address the environmental issues that we've spoken about, then it wouldn't make any sense. So I mean, I would say that yes, governance is very important for addressal of environmental and social risks. Maybe you want to add into that.
Yeah.
I absolutely agree with everything that Ruby has said. I personally find governance to be very important. And as I mentioned in my presentation, in Asia Pacific, many companies have concentrated ownership. So getting governance right is actually key in protecting shareholders' interests. And if we want to extend that to other stakeholders, that's even better. But I do want to make a point that we are all, social animals. We're social creatures, and there are prevailing trends or fashions that sometimes we get stuck in. And I think in the past couple of years, environment certainly has a lot of attention. And every time there is an extreme weather event, or when there's big bushfires or floods, then inevitably people's attention gets drawn to climate change and this potential systemic risks that climate change can bring. So I think climate change is also a subset of the E of ESG. And I think that's probably going to capture a lot of attention for both the private sector and the public sector. And I think we're also beginning to see governments and regulators focusing on banks and other financial institutions, on their lending, on insurance companies, and how potentially climate change will affect their operations, their lending books, and so I think that's a piece that will probably get increasing attention. And I think in the last 12 months or so, as the pandemic has taken hold, I've heard the expression that the S of the ESG is no longer the middle child. Okay, so the middle, the child in the middle normally gets very little attention, right? But I think that's also slowly changing, especially when we see some of the social movements out of the US. And in this region, I think we've also beginning to see some of the social issues being addressed in some of these projects financed by social bonds. And I'm sure the IFC is doing a lot of work on those as well. So I think depending on, I think, and the media is driving a lot of interest in some of these issues. I don't know how they will play out in terms of the various importance. But to me, I think from an investor's perspective, I will always look at the governance first. But that's not to say that other issues from time to time may not eclipse some of the governance issues that we see, that we have focused on for a longer time period.
Another angle to this, or Mohan, when he started off, said we are a 150-year-old company and we want to sort of ensure that we are there for an equal period or more. So now, perhaps would one argue that the process of quarterly reporting and the short-term basis of evaluation of companies and the lack of this information, as I mentioned in our CA code, we've said, recognize, measure, manage and report. So the measurement and reporting of these measures get reflected at the moment as non-financial, but its impact on the financials don't get highlighted. Manil, I mean, sorry to draw you into this without any prior notice, but if you have any views you'd like to share, in other words, people have been arguing that the financial statements, perhaps, do you need to support or supplement it with a value statement, a little more, these values that have a longer term impact on the institution, like even maybe the brands, the intellectual property, the way they deal with their human capital, the training and development processes. A lot of this is submerged in the documentation in the paper that is part of the annual report, but the value doesn't get reflected anywhere, and therefore it doesn't drive share price, or it doesn't. I mean, perhaps it does in some parts of the world, but in a less sophisticated environment. Any comment you'd like to make on that? Again, I apologize for drawing you in without any notice. Yeah.
So I think the issue here is, and I believe that ESG from a disclosure and reporting point of view will be the next evolution in financial reporting. Now, currently it's heavily skewed towards financial reporting in the sense of profits and asset values and things like that. So I think ESG will be the next evolution of this whole process, and in that aspect, even IASB is thinking of forming a separate standard setting board on this whole equation of integrated reporting and things like that. So it will go there, but I think the pandemic has probably opened our eyes to say that we are a little bit slow in this, and then I'm sure in time to come this will take center stage, because today it's not only about companies making profits, it's about the well-being of their employees, or it's about how they're protecting the environment, and a whole bunch of other things that are coming in. So I think it is going to go there, but it will take a bit of time, because one of the problems in financial reporting per se is this ability to measure something. And then hence you find things like brands and things that are intangible, which are not on balance sheets, because of this whole equation about how do you reliably measure is something that is being, I think, grappling the standard setters worldwide. And then what you can't reliably measure, they tend to keep it outside the numbers. That has been the general strategy. So, but given the importance of this whole topic, I'm reasonably sure there will be a set of guidance that will come out, plus standards, because you have to ensure that one of the key things is to ensure comparability in reporting. You don't want one company using one set of rules or principles and another company doing something else. Then these, from an investor point of view, this becomes not easily comparable, and then you can't really attach a lot of value to that. So there will be, I think, some evolution in this whole equation in time to come. Currently, this whole debate about reporting on things which are not in the financial statements, because a lot of things are given in the strategy statements and elsewhere in the annual reports. The question again arises as to the comparability of that information and the consistency of that information. So these are two aspects I think we'll have to deal with, but increasingly companies will start to give a lot more disclosures about what they're doing in the ESG space, that is environment, social aspects, as well as how the companies are geared from a governance aspect. How to monitor these areas will be something that will be disclosed, I believe.
Thank you. Useful. I think, yes, we are on a journey, and there will be solutions to these. If I may take the question, it's an interesting, it's about greenwashing. Who do you see as the main, or what do you see as the main deep reasons to cause for greenwashing by corporates? Is greenwashing happening at significant proportions? I guess these, perhaps to Mary, when you showed us the information about Europe being at 1,600 billion, I think, and 21 billion down there in Asia relative to population size, GDP growth, and so on. So somehow Europe has, for some reason, done this very aggressively over the last decade or more. One is any reasons, and is the greenwashing more significant in places like Europe, or would you like to relate these two in some form?
I think it's hard to quantify. It's hard to quantify the phenomenon that's called greenwashing. I think it exists to various degree in each market. But I think...
Sorry to jump in. Firstly, would you mind defining how you understand greenwashing? Because maybe not everyone on our participants group.
So the way I would look at greenwashing, again, from an investor's perspective, from an investment management industry's perspective, is when an investment product makes claims about being green or having ESG objectives or being sustainable more so than they really are. Okay, so so these products will claim that they have a certain environmental objective when really they don't, or they have no consistent way of delivering that claim. Okay, so that's what I would call greenwashing. So not at the corporate level, but at an investment product level. And if we look at what's going on in the EU, they have done a lot of work in trying to combat greenwashing, and some of the things that they've done involve new regulations and new legislation. So just to give you an overview, right? The EU is working on an EU taxonomy, which is like a catalog of every economic activity that will be classified as sustainable. So you and I can argue whether clean coal should be green or should be sustainable, right? In the EU, they have a taxonomy that tells you that if you want to be sustainable, it has to be in there. So that's the first thing. So that's the framework. And then they have this thing called the Non-Financial Reporting Directive, which mandates companies and issuers to report on things like the environmental impact, sustainability, human rights, anti-money laundering, that kind of thing. So these are non-financial reporting disclosures. And in April, the EU has proposed to upgrade this to what they call the Corporate Sustainability Reporting Directive, which will have additional requirements for companies to look at double materiality and to report on their value chains, to provide targets on some of these ESG metrics and provide assurance on these numbers. Right? Again, I think this is something that Mani was saying, that the accounting profession will have a key role to play. So we have the taxonomy, we have the companies making disclosures, and then the EU has also just implemented a regulation called the SFDR, the Sustainable Finance Reporting Disclosure Regulation. And basically, it catches all the asset managers and the financial services industry, and they will make these asset managers and financial advisors disclose how they are incorporating sustainability into their processes. And if you are selling a fund, a product in the EU, you have to classify it into one of the three categories that are Article 6, Article 8, and Article 9, with Article 9 being dark green and Article 6 being light green or gray. Okay, so they have all these regulations that will ensure that if you claim to be sustainable, you have all this information to back it up. And you think about the valuation, the chain of information flow, right? The value chain of information. Basically, you have to define, your universe first, and then from that, that's the taxonomy. And then from that, the companies will then tell you how, the percentage of their activities that are sustainable, right? And then the asset managers will look at the companies they are investing in and decide whether they would exclude or include certain investment opportunities based on the percentage of sustainability activities they have. And then in turn, they will take this data and say, this one is 100% sustainable investments, or this one is 50% sustainable investments. And that's how the EU has approached this whole phenomenon. Okay, now I don't think there's another jurisdiction that is as ambitious in terms of regulations to make sure that everyone in the ecosystem delivers. So I mean, and you can argue that, you know, this is a costly thing, right? Because regulations are costly, and it favors the bigger players who have the resources to report and gather data. So I don't know what the right way is, but I think from the perspective of an investment manager, an investor's perspective, when we talk about products, when we talk about returns, we have to be really careful, because we want to make our products as compelling as possible. Because having an altruistic goal is good, but we're talking about people's savings, people's retirement, people's livelihoods, and it's up to the profession to make sure that the products we offer are as compelling as possible, both from a return perspective and from the perspective of achieving, delivering additional goals. And I think it's very important that the profession can articulate that and be as clear and transparent with the clients as possible. Thank you.
Thanks. It brings me the same thing to a slightly different aspect of that question, maybe to Ruby. That was from a fund and product perspective, but when you go into a corporate and you are talking to them about bringing amount of funding into the corporate, the way how do you, shall I put it crudely, safeguard against greenwashing within that corporate? I mean, you see documentation presented to you, but then you've got to make sure that it fits in line with the expectations of the IFC in terms of the different areas that you explained. So I'm sure you encounter it in a very if I could call it micro sense, whereas what Mary explained was a much larger fund perspective of products. Could you tell us a bit about some of the examples and challenges and how you would overcome this aspect?
Sure. Thanks, Asita. So, as part of our IFCs, and as I've spoken about how important is ESG risk assessment, and it is very integral to all the investments that we make. And it is not just a one-step process, but we continue to monitor and we continue to handhold our clients on these aspects throughout the lifetime of our investment. We have an in-house team of E&S specialists, and we also take support from third-party consultants. IFC also, picking on the point that Mary was speaking about in terms of disclosure and transparency. So we also require our clients to disclose on the assessments that have been done. Also, as part of our disclosure process, whenever we are making any investment, we disclose what we call as an E&S review summary. And at a time when IFC is engaging with the client, we don't expect that the client would be fully compliant with what our requirements are. And that is where our role comes into play. We work with them. We agree on an action plan. And the action plan is actually, it's a document which includes the key actions that the client has to implement over a certain period of time. And it's not like everything has to be done in 1 month. So depending on how long an action will take, we agree on that. And we continue to monitor the project. We continue to supervise our projects throughout the duration. We visit the project sites also as part of what everyone was talking about in terms of disclosure. We require all our clients to submit what we call as annual E&S performance reports. And this is something which is different from the financial report, but this is a report which reports on how the project has been performing on environmental and social parameters, and also requires the client to report back on where they are with respect to implementation of the E&S action plan that would have been agreed as a condition of agreement. And based on this review of the annual E&S performance reports, and also based on our supervision visits, we then assign an E&S rating, what we call as environmental and social risk rating, to all our investments. And depending on how they're fared, then we, if the performance is satisfactory, then it's fine. But if we find that the performance is not satisfactory and there are certain gaps, then we make best attempts to help our clients and provide whatever support is needed so that they get compliant with our standards. So that's something that we work with our clients.
But could you is there sort of a stick approach as well of holding back a disbursement or anything like that, or it's more collegial and developmental? How do you?
So, I mean, we do require some, depending on a project, sometimes we do have some actions which are linked to disbursement. And this is something which we would identify at the time when we are doing the appraisal. And we identify that this is quite a big issue. Let's take an example. We are looking at investment in a company, and we find that the company is non-compliant with the labor laws, like the national labor laws. The overtime hours are in exceedance. The working hours are in excess of what is legally permitted. So we may then develop a phased action plan. And if it's a single facility, then let's say we may agree to that you correct this as a condition of, and disbursement and IFC is not always in a single tranche. There are sometimes multiple tranches. So also depending on when the disbursement is planned, we might link it to second or third disbursement, depending on when it is planned. And in some cases, it's also, it's not necessary that we link everything to disbursement. We could just agree on an action plan saying that you would do this in 6 months time frame. So let's say it relates to development of some procedures, some SOPs. So we would then, just link it to a timeline. And I mean, there's some things which are really crucial, like installation of life and fire safety systems, or, things which could have a larger impact. Then we do link it with some of the milestones like disbursement of. Thanks.
Thank you. That's helpful. Dinesh, do you wish to add anything from your Sri Lankan experience on the same aspect dealing with corporates here?
Yes, Mr. Talbot. So as part of IFC's engagement with clients in Sri Lanka, particularly in the financial institutions, when we started engaging with them several years ago, they didn't have any ESG frameworks in place. And over time, we have worked with them to build capacity and have ESG frameworks in place. So now going forward, they are now able to assess and manage the E&S risk of projects, what they fund, because this is a very real risk. So if you look at the region, for example, if you take India, the mismanagement of E&S risks has led to very high losses for even the top companies. For example, a notable example is Tata. So when they came up initially with the Tata Nano car, I forget the name of the state, but the factory was in a particular state. And because they did not manage the E&S risk with the local communities, they had to literally remove the factory from that state and relocate it at another state, and at a tremendous cost. And I don't think that the Tata Nano project ever recovered from that cost and that negative sentiments around that. So similarly, on the governance also, I think it's a very pertinent area which companies need to focus. Because again, if I look at in the region and India, like there have been several large financial scandals which have sort of affected companies, and retail investors have lost a lot of money. And each of these, if you see the underlying cause, it's always linked to governance. So having good governance is, I would say, is fundamental to attracting investment, and for investors, it's fundamental to ensure that their value is secure. Because if you have good governance, the chances of the company going bust and investors losing money is very remote. Mr. Talbot, I think you're on mute.
Sorry. Thank you for those comments, Dinesh. Very useful to give a few practical examples, because that does help us to relate. The one comment that has come from a participant is maybe to Rajiv, more than a comment, a suggestion, that, in the annual reports, yes, there's disclosure on ESG. One is encouraged by the stock exchange, other is the governance code that we have, the CA has put out and so on. But they're saying perhaps in quarterlies, in addition to the financial highlights and there's shareholder information and so on, to consider a couple of things. So we will leave the thought with you as we evolve and develop the reporting. Maybe that's not a bad idea to look at.
Yeah, thank you. Yeah, we'll take that on board. Of course, we need to strike a balance as to what type of information we ask companies to disclose so as not to overburden them every quarter. But I think certainly with the focus on ESG, perhaps some component of it may be useful, particularly for investors who are sensitive to that. We did speak about governance driving the S factor and the E factor, but sometimes you might find that governance may be in order, but they may be driven by, as I think Mary or we mentioned, more by short-term profits rather than the bigger picture of what you do for society. So I think just a quick comment that while we have all this, it may be regulations that really drive more and more corporates really conform, because of volunteering may take a long time for adoption, as we have seen. And we brought in the governance principles, yes, but perhaps we should look at the other factors as well if we want higher level of compliance, even for greenwashing, etc. Regulation may be one answer, particularly in this part of the world. Companies may see value and in terms of accessing public markets, and if you have to access public markets, you need to conform certain standards. So
I think very, very interesting observation. I think it will require another half an hour discussion, so I might want to leave. I think it's based on Mary's comments, Ruby's comments, and your proposition. I guess depending on the region in the world, depending on, be very careful in selecting words here. I'm not saying the level of democratic compliance or whatever the philosophy of the people. This whether regulation versus voluntary compliance is, I think, always an interesting challenge. Which how far on the road on each side one has got to be. But since we have passed the time, but it's been very interesting. I just want to, before we close, bring a topic which is very current to all of us and which we didn't talk of at this discussion so far: the pandemic and its impact and implications on corporates, and the requirement to disclose the pandemic-related, shall I say, implications. To be a little more explicit, now, for instance, companies continue to operate and bring their employees in. There's no choice. Sometimes it's in manufacturing process or whatever, where there's physical presence required. Then the question of, the balance of human rights versus economic implications versus all this sort of stuff. Where is the balance and how does one deal with it? And I'm wondering, can I pose the question to Ruby and Mary initially? I mean, and perhaps then to Mohan from a practical perspective. And, when we first started off in the first quarter last year, there was a requirement, I think, which came from CA for reporting. It was more from a risk perspective and so on. But then that quietly eased off, I think, and some corporates continued, some didn't. So, it may be a desirable thing because it's an ESG aspect and a very live ESG aspect, but maybe not given sufficient prominence. We are looking at saving the planet, centuries ahead, but we are not looking at the immediate. Whom can I place it with first? Ruby, could I ask you for a response initially? Now, companies which you have lent money to, do you all ask them what are you doing? What's the balance between?
Yes. Yes, on COVID, it has been, it is an unprecedented thing. It's something that nobody knew that we would land up in such a scenario. Even companies are grappling with how to deal with the impacts that COVID has embarked on them, right from and it's in different phases. Right, the time when COVID hit hard, there were cases wherein several of the companies were laying off the employees. There was large scale retrenchment. Then coming to a scenario wherein companies started operating, started calling back the people back to work, and with people getting infected by COVID due to non-implementation of COVID-related measures. So there are a range of issues that we deal with. Yes, the advice that we provide to our client is to involve the employees, have a consultation process with them in the event that they are no longer going to need so many people on the floor. There have been several cases where companies were required to retrench. Then developing appropriate measures so that the retrenchment is in line with the guidance provided, and we developed guidance on how to deal with such scenarios. We also developed guidance on occupational health and safety issues related to COVID, how COVID safety protocols should be developed and how it should be communicated to the employees. So we developed on a range of such topics, also on related to stakeholder engagement with the employees. Communication with the employees is a key component. At the time of COVID, there was a lot of uncertainty involved. People didn't know what was going to happen. People had fear in their mind whether they would be laid off or they would be asked to come when they didn't want to, whether their salaries will be cut, what would happen to all of them. So I think proactive communication is something that we do advise our clients to do in such scenarios, and to be, still remain strongly connected with their employees. Maybe Mary, you want to add something?
Thank you. Yes, very useful comments, Ruby. Thank you very much. Mary, would you like to add to that, please?
I think this is the by far the toughest question because I think obviously worldwide many companies have been struggling to survive COVID, and I think it's still too early to call as to whether as a result what the implications or linkage with ESG might be. And I think Ruby's examples deal with the social and the employee element, I think, which is more very useful. I think from a business investor's perspective, when you're evaluating a company, in the last 18 months, I think you'll probably be looking at how big is impact, how big the impact is COVID on its markets and on its sustainability, and that kind of comes up through in the way it handles its stakeholders. But I think on a bigger picture, and this may not be as relevant to a market like Sri Lanka, but what we are seeing in a number of markets is that there has been a lot of government support to the private sector, and in the form of quantitative easing. So a massive amount of monetary stimulus has been injected into the system, and that has the effect of floating all the boats in the ocean, as it were. And what that may mean is that the cleansing mechanism that is part and parcel of the capitalist economy is kind of put on pause, because a lot of companies are on life support, but they can't go bust because of all this government support. And sometimes we wonder whether we're storing up problems in the longer term, right? Because in the normal economic cycle, companies that cannot survive, they will go belly up, and capital will be recycled into other more efficient companies and ideas. But for the last 10 years, because of the massive amounts of liquidity in the system, that hasn't happened. And this time around, the problem may actually be even bigger, and yet we're not seeing any way out. So I don't know. I don't have a good answer to your tough question, but I think it's important for us as analysts, as investors, to make sure that we are factoring in some of these when we are evaluating the opportunities in front of us.
Thank you. Mohan, do you like to say anything on this topic?
I'll
Without the,
I mean,
yeah, I don't want to sort of push you to disclosing anything confidential about the company, but from a philosophical, your own point of thinking point of view.
Sure. Yeah, sure. I think what we did was we quickly moved to the long-term planning to the short-term planning, 1 month rolling, and so on and so forth. We start something called cash war room. The liquidity is a king. Then we start negotiating almost every expense of it. We start something called the expense tower. I think the whole high-level items we start negotiating. Is it required? Whether we can actually negotiate with vendors and so on and so forth. Then there are so many cost-saving initiatives started. I think we need to make sure that the employees are taken care of and so on and so forth. Then I think then there are a whole heap of activities happen the moment that the pandemic hits. CapEx went into that OpEx, and we curtail almost. I think other than it is a very required CapEx expense. Then if there's any deferment possible, because all in all, we need to make sure that cash retained within the group. The liquidity is the king at that moment of time. I think cash is the king. Then around that, we start work around all this initiative, and we manage to do these things and coming to this moment of time with these all changes happen in the country.
Thanks. So that's a very practical and a nice way of managing. So I wonder whether Manil or Dinesh wants to say anything about. My question really is, it's a time when we really put ESG to the test, whether the front line has to bear the brunt of exposure and where the C-suite can sit in their comforts of their home and give direction. So, I mean, given that scenario, ESG is really in a way being put to the test, and job losses and so on. So in addition to the practical aspects of what Mohan explained about costs and so on. So in a sense, disclosure, requirement of some disclosures around this would, in my view, be pretty useful. Manil, Dinesh, any quick comments before we close for the day?
Yes, now definitely a disclosure requirement will have to come in, but there are I think the critical issue is going to be consistency, and then comparability is going to be an issue, because you put out all this information. The next question is, how do you evaluate this information? So if there is going to be someone who has to second guess or basically validate this information and all, then that the whole purpose of putting that information also becomes a bit of a the value of that will come down a bit. So I think as we go forward, we may need to have some form of developing best practice or benchmarks, or some form of standardization will have to come to bear, because otherwise you're going to have, say you have 100 companies which starts disclosing various different ways of disclosing maybe the same fact, but different ways. Now the question is, the reader or the user of this, how are you going to make sense out of all this is going to be I think the challenge. So clearly I think there will be some areas of disclosure that will come through. There would have to have certain standards, and I think that is where probably the institute with Rajiva from stock exchange, whatever it is, we may have to develop some standards in the absence of any global standards on these things. The best practices, even you might have to, because it's reporting and it's difficult to validate some of this, you may have to come to some sort of a benchmark. So that's an area that will have to come, and I believe many corporates from ESG point of view, I know there are cost implications, but I think they'll have to realize that sustainability, to achieve sustainability, you will have to look at some of these factors like the environment. The environment in which you work is going to sort of drive a good part of sustainability. So it's not only profit, which I think historically we have been brought up to believe that if you have profit, you can do anything. But increasingly from this conversation and various examples quoted, it is shown that profit alone is not going to drive away some of those other impacts. So if they believe in sustainability, I think the rest of the pieces will come into place. And from a reporting point of view, those practices that are that they have followed and done, if they were disclosed, I'm sure from a valuation point of view, analysts and various people will place value on that and value those companies much better than the companies which don't follow these practices. Thank you.
Thank you, Manil. Very, very valuable and useful comments. I think in the interest of time and to international the participants in the presenters would also need to clock off time is catching up with all of us. We've overrun time. So thank you very much to the panel, to Ruby, to Mary, to Rajiva, Mohan, Manil and Dinesh for sharing their time and knowledge with us. And to all of those who signed in, I hope you had an interesting 2 hours of discussion to listen to and gain by it, and that we will all work towards improving the ESG practices in the local corporates. Thank you very much and have a good evening.
Thank you.
Thank you. Bye-bye.
Thank you.